Hi, it's Troy Griggs with Obsidian Wisdom. Today we'll be answering the question, what is a realistic stock market return? When it comes to your stock market return, it starts with just what your reasonable expectations are and whether your expectations are even that reasonable. What I mean is, oftentimes what we see in the news or we're told in our experiences, that becomes what we expect to be the normal. If you were to see on the news every day that someone was bit by a shark, then every time you went to the beach, you would expect to see someone get bit by a shark, even though that is very rare and doesn't happen very often. The same would be true if you're talking about really any of those unique disasters that if we see it happen on a regular basis, whether we're on social media or whether we're looking at the news, we then begin to expect that to be a normal part of life where our expectations have changed because of the frequency that we saw something. The same can be true with your expectations when it comes to fishing. I have taken all of my kids fishing at different parts of time, and I set the expectation that the number one thing we want to do is enjoy our time together. We want to make sure that we are having a good time, that we're laughing, that we're talking, and whether we catch fish or not, it's about the experience as a family. The reason I do that is because I know that it's very likely that all of us catching a fish is unlikely. Even though when I talk about fishing, I'm always going to talk about my best experiences where I caught the big one, where I have this picture of the hugest fish that I've ever caught in my life. And I'm like, yes, that's me, amazing fisherman dad. Even though I can say that that is a rare occurrence, because it has happened, that is something that I like to celebrate, something I like to talk about a lot. The same is true when we talk about the stock market and we set our expectations. When we talk to people who have been successful, they always talk about that one stock, how they invested in Amazon, and that was the only stock they invested in. And then in a matter of a few years, they have $1 million and they love it, and the stock market is great. And then people are like, man, I missed that moment. Let me see if I can find the next great big stock. And then you're looking and you're like, oh, this new IPO is coming. Maybe I should invest in that company before everybody finds it. Where can I find the new diamond under the rough so I'm able to have the same story for myself? When the truth is that that is not a common occurrence. It is very rare that we jump on such an amazing company early on and we ride the wave the whole way. Most of us, just behaviorally speaking, when we get some gains, we're like, okay, I don't want to mess this up, so I'm going to go ahead and cash out now. It's very rare that we would say, oh, this is just going to keep going up and I'm going to ride the wave all the way to the top. Like that just rarely happens from a behavior perspective. We don't believe that most small companies are going to become the S&P 500 size companies. We generally will say, let me just go ahead and lock my wins in and let me get out of here. And the truth is, a lot of those companies don't make it. That's why we have that expectation. Generally speaking, a company is not going to come out of nowhere and take over an entire industry. So we shouldn't be just looking every day for the next Amazon or the next Facebook and things of that nature. But those are the stories that we hear. On the other hand, the other type of stories that we always hear are the ones where we lose all of our money, where someone is saying, look, my brother invested in the stock market and they lost everything. Or my sister, my mother, they lost everything in the last recession. So I don't invest in the stock market at all. If I put money in there, it's going to be all gone. I can't do this, Dre. And the truth is, we're somewhere in the middle. Normally, when you talk about the average return in the stock market, that is going to be around 10%. Now, it doesn't mean that you should expect 10% every year. The fact is, the majority of the time, you won't even fall within an average of 8 to 11%. You'll normally have really high years. For example, in 2021, the average return was closer to 21, 25%. But then you have the other years where the average return could be much, much lower. And then you average somewhere around that 10%, which is also why a lot of people aren't as successful in the stock market, because when they have the lower years, they become very pessimistic. They don't believe the stocks are ever going to rise again. And then we become overly confident in the good years where we're saying, let me put all of my money in this stock. This is going to be the thing that takes me over the top. We should have a realistic expectation. If the market on average is 10%, but it's not super common to be in that 8 to 11 range, but it's actually much more common to have 21 year and 5 the next year, or 0 one year, or even a negative possibly some years, depending on what you're doing, then you need to say, okay, I need to have a plan for the long term. Now, I'm not saying that you have to invest in something and leave it there forever. The truth is, people ask me all the time, Dre, when should I take my money out of the stock market? And generally speaking, you should take your money out when you have a better place to put it. If you don't have a better place to put it, then you should leave it exactly where it's at. If you have a better place to put it, then you should move it there. And what decides if something's a better place? That generally could be anything from the company, and the reason you invested in the company is no longer true. That company has completely changed. Maybe the leadership's changed, the vision has changed, where you just don't feel as confident in the company and the vision anymore. It could also be if you're coming closer to retirement or whenever you need the money. If you put the money in to purchase a home or pay for your kids' college, you should start exiting that ramp. And when you exit off the highway, you don't just continue going at 100 miles an hour. You have to start slowing down because the speed is much slower when you're exiting the highway and entering onto the city streets. And so you can't just keep going 100 miles an hour. You have to have a little bit of space to start slowing down. Your investments are the same way. You cannot keep your pedal to the metal and continue striving for 15, 20, 30% returns when you know that you're going to be using the money in the next 5 years. There is a level of risk involved in our expectations. Even though they may say, look, on average, you're at 10%, you have to also consider things like inflation and the risk. If someone is taking a significant amount of risk and they're getting an average return of 10%, I would tell you to run away from them. Because someone getting a return of 10%, but the lowest based on the risk that they have may have been like 7%, versus someone getting 15%, but based on the risk they have, the lowest they could have gotten was negative 10%, you may not be excited about the volatility in that portfolio. There's already volatility in the market that is going to impact the returns that you get. So it's important to take risk into consideration when it comes to the returns that you are getting. But if you're interested in getting a 10% or higher return, then there's a couple things you want to keep in mind. The first is how long you're going to be invested. You need to be closer to 5 years than 5 months. You will find that if you're only in something for 1 year, you can get lucky. You can have a great year. But if you want to be consistent in your return, as I mentioned, you're going to have some highs and some lows where it's going to give you that average. So the plan should be to ride these different waves, to have a consistent plan where you believe in the companies that you're investing in. And then when the market is going down or the market is going up, you believe in the strategy that you have. The other thing that you want to consider is which stocks you're invested in. US large caps in 2021 had an average return of 26%. Now I put a chart up where it shows you the 3, 5, 10, and 15-year return as well. When you compare the 2021 returns to the 3, 5, 10, and 15-year returns, you'll see on average you have the 10% return that we were talking about. If you're looking at mid caps in 2021, then you would have seen a return of 23%. Mid caps are companies that are $2 to $10 billion in size. When you compare the 2021 return to the 3, 5, 10, and 15-year returns, again, you can see the number is closer to 10% even for mid caps. In 2021, as we were coming out of the COVID lockdown, there was significant growth in the stock market. That is because the Fed was putting money in the stock market, the interest rates were at near zero, and you also had the money that was being printed and given to the consumer. So the consumers had a lot of money, but a lot of companies were closed, so they didn't have anywhere to spend it. And now companies are opening, so everyone has this money that they were sitting on. So the stock market was very optimistic, and it grew as a result. So that year would make it an outlier. Also, if you were to go back and look at the COVID lockdown, well, don't be surprised that year that a lot of companies lost a lot of money because there wasn't people buying things. Everything from the energy market because people weren't driving, and you notice that gas went down, to different restaurant industries because they were closed. If you look at any 1 year, the returns may be much higher or much lower than the average. But when you look at over a span of years, you'll see that we're closer to that 10%. If you're interested in investing in small caps where you're going to look for the diamond in the rough, understand that that has an average return of 8.5%. They were at 24% in 2021. The international large cap stocks, those are companies abroad. In 2021, they had a 10% return, but their average return over 15 years has been 4%. Long-term bonds, intermediate bonds, and short bonds have all been negative or just about at zero for 2021, but they average around 3 to 6% over a 15-year time frame. What you can expect from your returns also depends on the type of stocks that you're investing in. If you like the video, I ask you to like and subscribe, and feel free to check out other Wisdometric videos if you're looking for ways to eradicate financial stress, generate passive income, and build a prosperous retirement strategy.